Welcome back. Let's now put the spotlight on the cement sector as we enter into the Q3 quarter. Let's find out how Q2 has been. Pulkit Patni, who is the India Industrials Analyst at Goldman Sachs, is now joining in. Pulkit, morning. This is Rima here. First, just tell us how Q2 has panned out, because we were just reading your report and you highlight that volumes were weak, but pricing has been resilient. So take us through the key numbers for the industry in Q2.
Sure. Thank you for having me. In the report, what we've highlighted is that the second quarter was a muted quarter in terms of demand at about 4% for the industry. And if we look at both Q1 and Q2 added together, we're still at about 4%. But from a pricing perspective, where we were positively surprised is that the price increases that were taken in the month of April have almost continued through. Yes, the typical correction that we see in monsoon has come through, but net-net, we are still in a pretty good position when it comes to the pricing overall. Now, this is what is actually driving us from a relatively more cautious view on cement over the last few months. We've become incrementally more tactically positive on the sector because as we get into the second half, we think demand is going to pick up, even though we may be in a relatively softer pricing environment after what we've seen in the first half.
Okay. So can you explain what is making the prices resilient despite a tepid demand of just 4% in Q1 and Q2? I mean, what explains that? What does it mean in terms of the EBITDA per ton that we should expect in Q2? Because Q1 was also pretty strong, led by the price increase. So what would the number look like in Q2? And though you've turned incrementally a little more bullish now on the sector, you have only one buy idea, and that's UltraTech Cement.
Sure, absolutely. So let's look at what's happening in the cement sector. This is a sector that's going through significant consolidation. That consolidation has had its impact on pricing. If you look at the last year, we did not see any major price increases. As we got into this year where demand was relatively weak, the industry could take price increases. And that is typically what happens during a period of consolidation, that price control becomes a lot better for the larger players. Now, let's look at the second half of this year. Demand should get better. Reservoir levels are at its peak. Typically, there is a pent-up demand period that happens after monsoon. And then this year, November, December are going to be clean months from a festive perspective. So that is why we are feeling confident that in the second half, demand actually should come through. And that itself is a reason that we think tactically things should be better. Now, from a industry perspective, valuations in this sector are still fairly rich. And that's why we have to look at stocks specifically. But from an industry perspective, we do think that second half looks a lot better.
Pulkit, you said you were positively surprised by the pricing resilience despite the weak demand that you have seen. Is that price resilience in anticipation of the uptick or the potential uptick in demand that you are anticipating in the second half of the year? And if that does happen, does that price resilience percolate into further price increases going forward?
So when we talk about prices in particular, as I said, that the first quarter price increases were stronger. In the third quarter, where we are sitting today, we don't expect any meaningful price increases. And that is driven by the fact that there is also a lot of capacity that this industry continues to add. Where we expect price increases further to happen in the cement sector is next year. So you can look at calendar 26, which is fiscal 27, where we think price increases will come back in the sector. Also, keep in context one important point that we have been through a 6 to 7% price increase in the first quarter. And even if for the rest of the year we don't see much price action, I think that's good enough for the sector from a profitability perspective. What we are looking at the sector from a profitability standpoint is about 200 rupees per ton of improvement into the next 2 years from the base of FY25. And if you were to talk about the quarter in specific, which is basically a quarter impacted by monsoon, we are looking at a sequential decline of 200 rupees per ton, which is not something that should come as a surprise to anybody.
Okay. Pulkit, we spoke about pricing, we spoke about volumes, valuations as well. Any other aspect or fundamental that an investor should look at before looking at this particular sector, widely tracked, but other than these metrics, what can one look at to understand what the future holds in terms of the space?
Sure. I think if you look at consolidation as a theme, right, while obviously every sector is different, look at paints, look at aviation, the industry leader in most of these sectors have more than 50% market share. Now, we are not saying that will happen for cement, but for the larger players, we think there's more room for them to consolidate market share. And that's a theme that is going to work through the next couple of years in the sector. I think what we have to also keep in mind, which is very, very specific to the larger players, that we are seeing that the focus on cost for the larger players is only increasing. And so what you're going to see over the next couple of years is that on the cost front, the larger players will completely price out the smaller players, which will further drive industry consolidation. So answering one of the questions previously on valuation, that while the sector is seeing a rich valuation in certain pockets, what is important is that there's a clear dispersion that the market is seeing, where large consolidators are seeing higher valuation, and we see no reason why that changes. And companies with relatively slow growth are trading at much, much lower valuation. And that's a dispersion we expect will continue.
Okay, all right. Thank you so much for joining us today with your thoughts and outlook on the cement space. That's the word coming in from Goldman Sachs. Time for a short break now. We'll get you more on the markets on the other side.